So now we're getting to the equity method. And the equity method is what we use when our company buys 20 to 50% of the shares of another company, of the voting shares. This means that we have significant influence over them. And so the way to think about it is that if Z Corp has bought H Corp, and this is H Corp's retained earnings, if you think about the assets minus the liabilities, gives you the stockholders' equity. And if we own a certain percentage of H Corp's retained earnings, so if we have bought 25% of that company, we're kind of responsible for about 25% of the results. So under the equity method, the accounting reflects the fact that we have some say in the operating results of this corp. And so essentially when we make our journal entries, if H Corp declares dividends, we're going to be reducing, that reduces their retained earnings when they declare dividends of say 60,000. And so we're going to reduce our investment in that company by our percentage ownership of those dividends. So we'd go 25% times 60,000. If H Corp declares a 200,000 in net income for the year, why, we're responsible for 25% of that, or we have significant influence. So we're going to actually increase our investment in the company by 25% of their net income. Okay, let's see how this works with the journal entries. On 1/1, we buy some shares of Z Corp. So we would have our stock investment. And this is where it's a good idea to put down the percentage ownership, 25%, because we know with that amount we'll be using the equity method. And for our equity method, we're going to ignore the transaction costs. We kind of got those in the cost method. So when we buy the stock investment, we simply say, yeah, we paid $180 for it, and that's our stock investment. When they declare dividends and pay dividends, as I said, that reduces their retained earnings. So at the end of the year, we are going to make an adjustment to our stock account, our stock investment, based on that. We're going to receive cash dividends, and if we own 25% of the stock, we would get 60,000 was the total dividend, times 25% of that, we would receive 15,000 in cash. So we go 15,000. And then here's the weird part of the entry. This is what makes the equity method different. We are going to reduce our stock investment in that company by our portion of their dividends, because it reduced their retained earnings, and we kind of control a quarter of it. Okay, the other thing we do, this is kind of the reduction, at 12/31, they declared net income. And so we're going to increase our stock investment in this company. We'll make these adjusting entries at year end. And we would take their net income, the 200,000, times the 25%. And so we would up our investment 50,000. Okay, so there's the 50,000. And now here's another weird thing we do. We actually book that as revenue. Revenue from stock investments. And that would be other revenues and gains right on our income statement. We pay taxes on it, the whole 9 yards. So when we're valuing our investments that are at equity on our balance sheet, we would have here's our stock investments, and this is 25% ownership, so it's at equity. We started out with the 180,000 in it, when they paid the dividends, we reduced our holdings by 15,000. And then when they declared the net income, we increased it by our portion of their dividends. So we end up with a balance of 215,000. And so on our balance sheet, this is the number we would report. And we would report these stock investments, more than 20 to 25% owned, at equity. And so that's your equity method. And I think the notes give you a bit of explanation on this, and if you have more questions than that, please let me know.